Our next guest is someone that we've been quoting all morning long. He's Mohamed El-Erian, the CEO and co-chief investment officer at PIMCO, who said yesterday that even if lawmakers reach a short-term debt deal, the U.S.'s AAA rating is at risk. Let me just read you what Dr. El-Erian wrote yesterday in an email. He said, it is, quote, likely that the nation's leadership will stumble into a short-term compromise over the next few days, one that raises the debt ceiling and avoids a debt default, but importantly, leaves the AAA rating extremely vulnerable. Dr. El-Erian is here with us. Great to see you again, joining us from your offices out in California. And why do you say that? Why do you say it's still vulnerable even if we get a deal?
Because, Betty, the rating agencies, S&P in particular, have made it very clear. They've put the AAA rating on negative watch, which means that the presumption is of a downgrade unless something happens. And they've stated what should happen in their mind, which is a grand bargain, a significant fiscal reform package. And so far, what we're seeing is something akin more to a mini deal or even a short-term stopgap, as opposed to a grand bargain.
How soon do you think, I mean, let's say, even if we do get a deal, right, how soon do you think that we could possibly see a move on the rating?
That's only up to the rating agencies. It is very difficult to predict their behavior. So they are going to be under enormous pressure from, on the one hand, what they said, which is we will downgrade unless this happens. On the other hand, fear of the consequences of downgrading. So the rating agencies are being put in a very difficult position, and only they can decide when it is and if they're going to downgrade.
So Dr. El-Erian, then tell me, what are the scenarios that will play out regardless if we do or do not get a debt deal? What are the scenarios? Okay, well, actually, let me just first play that scenario out. If we do not get a debt deal and we technically default, what is that scenario going to be?
It will be a mess, a big, big mess. If we do default, we will trigger all sorts of legal contracts. There will be all sorts of sudden stops in the financial system. Remember, it's not just that we are AAA, we are at the center of the global financial system. So a default would be consequential. My expectation, in fact, our expectations is you don't get a default. Our expectations is you get some sort of last-minute compromise that avoids a default but has both immediate consequences and longer-term consequences.
I'm glad you led me down that path, because if we get some sort of short-term last-minute deal, what then is the scenario that plays out after that?
The immediate consequences all are in terms of what happens to the AAA rating. The longer-term consequences are twofold. One, this is not good for the economy. It involves more uncertainty. It means lower investment. It means lower growth and lower employment creation. So it's not good for an economy that is already struggling to gain a growth momentum. Secondly, it's not good for the standing of the U.S. in the global system. Sorry.
Well, because that raises the issue for me then is, you know, when I was reading through your email, you know, when you read through more and more about, you know, what you're saying about the context of all of this, you know, it raises the question whether or not the U.S. even deserves a credit rating of AAA.
Look, the U.S. is the largest, strongest economy in the world. The U.S. is the supplier of the reserve currency. The U.S. is the provider of a financial system that intermediates other people's savings and investment. So the U.S. is a AAA. The question is, can the U.S. maintain its AAA? Remember, there is no other country that can step in to replace the U.S. at the core of the system. The U.S. is the strongest economy out there, but it has to stay strong to retain its AAA.
And maybe that is why, Sara, right, you have not seen these bond yields move as crazy and as sharply higher as you might expect.
It's a big surprise. Dr. El-Erian says he is betting on a deal for the U.S. debt ceiling, and investors in the bond market are too. Treasury yields have stayed relatively low. It's a big surprise. It's not the Armageddon crisis Lehman moment that we have been warned about, and that is U.S. investors are still buying treasuries. Investors around the world. One part of the curve to watch is the 30-year bond yield, because that one has moved, and we are seeing it now trading at a 2-week high. Still, it is not the panic that you might expect here. Judging by the market, we're not going to default. In fact, this is investors' way of calling Congress's bluff, saying this is just political theater. We're expecting a deal to get done.
Well, talking about treasuries, I mean, obviously, Mohamed El-Erian has, you know, with him the world's largest bond fund, a huge holding in treasuries, and you've bought into treasuries recently. So what are you going to do? Let's say if we do default and we pass that August 2nd deadline, what are you going to do with your treasuries?
Well, Betty, any investor, whether it's PIMCO or otherwise, has to think of the following issues if the risk of default is high. And I say if, because our central scenario is that the U.S. does not default. First, what are the implications for the portfolio? Second, what are the implications for operational issues? Remember, treasuries are posted as collateral. Thirdly, what are the implications for investment guidelines and investment benchmarks? So this is very consequential. As we see it, Betty, it is not really a question of default as much as it's a question of the possibility of a loss of AAA. When we look at what that means for the bond market, most likely it is a bear steepener for the U.S. Treasury curve. But remember, U.S. Treasuries are in this tug of war between interest rate risk and credit risk. It is more likely that you will see a sell-off in equities, in the dollar, in commodities except for gold. Those are the more likely consequences of a downgrade. And the Treasury is most likely going to bear steepen, but that is subject to this tug of war between interest rate risk and credit risk.
Because it's interesting, but what I'm trying to drive at, though, Dr. El-Erian, is you know, what we've been reading about is how are people preparing, right? How are institutions preparing, and what are their contingency plans? So even though your central case is that the U.S. is not going to default, what are you preparing for? I mean, what is the dialogue going on in your offices right now? What would happen on August 3rd if, in fact, we didn't get that debt ceiling upgraded?
So I can't speak to other companies. Let me tell you what's happening at PIMCO. We've had a lot of analysis, a lot of discussion on, first, what are the investment implications? How do you safeguard your clients' assets through this very unusual and to some extent unthinkable situation? Second, what does it mean for our day-to-day routine operation, for the posting of collateral, for how we invest our cash? Third, what does it mean for our clients' guidelines? Are they written in terms of AAA status, or are they written in terms of government debt language? Fourth, what does it mean for benchmarks? So there is a lot of work that gets done to assess what is this scenario. The reason why I stress this, Betty, is it may be a very low probability, but it will be very consequential. So just like before Lehman, investors should be looking at different scenarios.
Well, we are continuing our discussion on the deficit and the debt ceiling. For more, we are joined by a friend of the show, BlackRock Senior Fund Manager and Head Portfolio Manager of BlackRock's Basic Value Fund, Kevin Rendino. He oversees a total of $12.1 billion at BlackRock. And of course, still with us is PIMCO's CEO and co-CIO, Mohamed El-Erian. And Kevin, you were listening in on the conversation I was just having with Dr. El-Erian, and asking him, and he was talking about the conversations going on right now at PIMCO about what happens if we get a debt ceiling upgrade or if we don't. What are the conversations going on at your offices right now? I mean, what are clients asking you?
Well, clients are asking, and we're asking ourselves, what are all the implications of all the possible scenarios that can occur if we default? If we don't default, but we have a small deal, what does that do to the Treasury, to the ratings from S&P and Moody's? And basically, we have going through disaster scenarios. Sort of, what is the market?
Give me one. Give me an example of one. Like, let's say if we default, what would you buy? What would you sell?
We know the immediate reaction is going to be a massive sell-off in not only equity markets, but probably the bond markets as well. And what do you do as a result of that? We think that that'll only be a short-lived circumstance, a 2 or 3 day problem, and then in that environment you want to sort of buy risk assets. Do you want to buy those risk assets ahead of the potential of that scenario? No. But in case that scenario happens, what are you prepared to buy during that 2 or 3 day period where the market can sort of?
So you would be prepared to buy what then in that 2 to 3 day window?
Equities. We think equities are the best deal out.
To buy equities.
Absolutely. We think equities are the best deal out there. The interesting thing about this entire scenario is we're worried about the debt ceiling not getting extended. Then we're worried about S&P and Moody's basically downgrading the credit worthiness of the U.S. In government.
Right.
And the first thing that we do in that environment is buy treasuries. That doesn't make any sense to me.
No, but there's been a lot in the markets that have not made sense so far with the backdrop of this. Let me turn it back to Mohamed El-Erian. I mean, what do you make of that? In that 2 to 3 day window, Kevin Rendino says that he would buy risk assets.
I think Kevin is right in terms of the overall principle. I'm not so sure he's right in terms of the time frame. Let me explain. In terms of the overall principle, this would be a technical default rather than a fundamental default. So were it to materialize, we would expect that it would be reversed quickly. And therefore, you would expect risk assets to bounce back. So he's right in terms of this is a technical default, not a fundamental default. But the time frame is important because this is not the only thing that's going on out there in terms of macro uncertainty. Europe is still out there. And importantly, we don't really know the consequences, the legal consequences of a default. So there's going to be a lot of uncertainty. So I would not go in with the rule of 2 to 3 days. I would go in saying at some point this will be an attractive buying opportunity, but one has to monitor developments very closely because we would be in the land of the unpredictable at that point.
Is there any, it reminds me of the follow-up to all of this, which is after, whether it's 2 to 3 days, whether it's 2 to 3 months, at what point do we get out of this? How do we get out of this crisis? Mohamed, how do we get out of this?
We get out of it through what we've called at PIMCO a Sputnik moment for the U.S., which translates into realization by politicians of both parties that there are a number of difficult structural measures that have to be implemented if the U.S. is to restore economic growth, create enough jobs, and restore financial stability. So what you need is a Sputnik moment. You need the politicians to realize that this is a particularly critical point in U.S. economic history.
I would have thought that S&P announcement of a couple of weeks ago basically telling the world they're going to downgrade the debt of the United States would have been that moment.
That Sputnik moment.
That Sputnik moment. It doesn't appear to, given the dialogue over the weekend, and that's what's very depressing.
Well, that's an interesting point. Why don't you think that was, Dr. El-Erian?
I think because first people entered this whole negotiations with a lot of preconceived ideas and positions, and therefore there's been less flexibility than we've seen. Secondly, let's not forget how difficult this is to explain to politicians. Thirdly, there are elections coming up. Remember, the U.S. is on a 2-year election cycle, and structural measures are by definition not attractive to politicians because they involve upfront sacrifice for longer-term gain.
Mohamed, talk to me about foreign investors this time around, because you've been traveling the world talking to foreign investors. What's their scenario? How are they looking upon what is going on here in Washington? What are they saying to you?
They're confused. They're asking lots and lots of questions. They're unsettled by how dysfunctional U.S. politics has become. And they're wondering, what do we do if the country at the center of the global system doesn't maintain its AAA? So this is a very uncertain time for global investors because they, like everybody else, assumes that a AAA remains a AAA.
But are they prepared, when you talk to Chinese investors or whatnot, are they prepared to take their money out of the U.S.?
The good news for the U.S. and the bad news for many investors is that there is no other country right now that can step in and take over the role of the U.S. at the center of the system. There is no other AAA out there that is big enough and economically strong enough to play that role. So that's one of the things that makes it so unsettled. You see the system not operating the way you'd like it to operate and you expect it to operate, but there is no easy replacement. And we don't know how a global system operates with a AA at its core as opposed to a AAA. And that's why it's not that simple for anybody to navigate this process.
And Kevin, you're agreeing with this?
I absolutely agree with him. I want to ask Mohamed a question about China in particular because they've been the buyer of last resort of all of our bonds. What is their dialogue with Washington through this crisis?
Kevin, I don't know. That's a question best asked to the Chinese. The public statements, as you know, have been to remind the U.S. that it has a global responsibility in terms of maintaining its public finances in order. But I don't know what they've been saying privately.
Is there any assurance, because there are reports this morning that Secretary of State Hillary Clinton is trying to assure the foreign investors that we will in fact get a deal and that the debt ceiling will be raised. Is there anything that can be said to assure them, or is it all going to have to be action from here on out?
I think it's going to have to be action.
Go ahead, Mohamed. I'm sorry.
Sorry, Kevin. I think it's going to have to be action. Let's not forget that we have a deadline, whether it's August 2nd or whether it's a week later. We have a deadline out there. So it has to be action at this point. Talk is not going to suffice.
And I think the most important part of this entire dialogue is not necessarily whether or not we raise the debt ceiling. The answer to our debt issues is necessarily, in the short term, it's raising the debt ceiling. But we've got to fix the budget deficit. We've got $1.5 trillion deficit. We've got $15 trillion worth of debt out there, and we've got to fix that. That's the key. We're going to be able to.
But that is just too big of a problem for Washington to take care of right now. Clearly.
Well, they need to start the program of putting us on the right path. Even a short-term agreement to some extent would be putting us on the right path, but we've got to get going at some point. We've kicked the can down the road as far as we can.
So what stocks would you be buying right now?
So we happen to have been buying all large-cap multinational companies that can take advantage of the faster growth that's taking place outside the U.S. So whether it's Pfizer, Microsoft, and in the last 3 or 4 months, we've actually, for the first time in a number of years, been pretty aggressively buying banks. Citibank, JP Morgan, Wells Fargo. That group is the most hated group in the S&P. Most of those stocks trade at a discount to book value. And historically, if you bought a bank when book value is growing and you bought it close to tangible book value, that's been good risk reward. A lot of uncertainty that's taken place in the last few months with regards to the banks, but we think that's created the opportunity.
Okay, and I do want to talk with you more about your bank holdings and those that have come in and out of his top 10. And also thank you to Mohamed El-Erian from PIMCO for staying with us through the half hour.